Hi everyone, welcome to the Mortgage Minute with Lorne Cooper and George Tinnis. I'm with Century 21 Heritage Group and George is with Centum Mortgages, and we are going to be talking about a whole bunch of different topics, a bunch of different episodes, and we're going to get into it right away.
Lorne, thank you very much for inviting me today.
My pleasure.
Appreciate it.
So George, what's happening with the mortgages these days? January 30th, 2018.
Well, a lot of things have changed, as probably a lot of people are aware of out in the market. Stress tests come into effect as of January the 1st, where all mortgages now have to qualify at the discounted rate plus a 2% rate increase that gets added on to that to be able to qualify. Hence, it just means that people are qualifying for a little bit less mortgage, but still buying within their means. Interest rates have gone up from, I'll say, August last year until today, where the variable rate has moved up about 3/4 of a point with 3 prime rate increases over the last 5 months.
It's a lot of increases.
It is. You know what, it appears that interest rates are going right back to where they probably should be. It's probably not what everybody wants to hear, but you know, the reality of the world is that's where we need to get to. The 5-year fixed rate mortgage has also increased by close to 1% from where we were last year at this time. So hence the outlook as we start moving forward into 2018 is we're going to see a little bit more in the rate increase on both the variable and on the fixed term mortgages, but nothing that's going to be outrageous.
And what's the spread on variable versus fixed?
Right now, people can get a 5-year fixed on a conventional mortgage where they've got 20% down at an interest rate as low as 3.39%. A variable rate mortgage on a conventional as low as prime minus 0.9%, which means that would be about 2.55%. On the high ratio insured mortgages where clients are putting less than 20% down, the interest rates are a little bit better, where a client can get into a 5-year fixed at 3.09% and a variable rate that would be similar at prime minus 0.95%, so in the vicinity of 2.5%.
All right, so let me ask you a question. Because now there doesn't seem to be a benefit on the surface of putting down over 20%. So would it be advisable to put down less and therefore get a lower rate even though you're paying the CMHC fees? How does that work out?
Okay. When you put down less than 20%, of course, there's a CMHC fee that gets added to your mortgage. And very simplistic, that's about 4%. Now, as you put more down, whether it's 10% or 15%, of course that premium drops from 4% to 3% to a little bit less. But it's still a lot of money when you think about a $400,000 mortgage and all of a sudden you're getting $16,000 added to your mortgage.
Right.
Does a 25 basis point or a 0.25% rate decrease offset that cost? Absolutely not. So
Okay.
People are still a lot better today by putting down 20% or more and taking a little higher rate, as opposed to putting less than 20% down, getting the lower rate and paying the CMHC fee.
What about the 19.5% down? Would that be a good way to go?
Still would be a good way to go.
I know people are thinking it, so I have to ask it.
Yeah.
All right, excellent. Thank you for the update.
My pleasure.